In this video, I'm going to show you how to build a portfolio that beats actively managed portfolio managers 95% of the time. And the best thing about it is that this is probably going to be the easiest portfolio that you can ever create. You're not going to have to learn anything about chart patterns. You're not even going to have to read an income statement for any companies. This is probably going to be the best and laziest way you can invest your money. If we haven't met already, my name is Anfernee McLemore, and I like to make videos about personal finance, investing, and making money online. So before we get into this gem of a portfolio, do me a quick favor and tap that like button for your boy, as it really does help my channel out. And I know before we even talk about setting up this portfolio and putting your money into it, you may be a little bit skeptical about what I said in the intro about how this portfolio can beat actively managed portfolio managers 95% of the time. And that is because the portfolio that I'm talking about in this video has everything to do with index funds. And if you've been around the channel for a while, you know that index fund investing is one of my favorite style of investing. You cannot get much more diverse than buying an index fund, because whether you get an S&P 500 index fund or a total market index fund, you are essentially buying a piece of the overall economy with as little as $1 sometimes. And with the way times have been changing recently, you can do this all for a zero expense ratio, meaning that in some cases you won't have to pay anything to an index fund manager for the privilege of it keeping up with the overall economy. Now, if you put this in contrast to actively managed portfolios, you usually have to pay a fee for the privilege of doing business with them. Whether it's a high fee or a relatively low fee is not really the case. Moreover, where they have to make money in some ways, and that money comes from charging you to do business with them. And because of this fee that they typically charge, your returns are on average lower than they would be had you invested in a passively managed portfolio. So with that being said, what exactly is this 3-fund portfolio that I'm talking about? Well, the foundation of the portfolio is simple. Number one, we want to have a portfolio that has a good consistent return with the overall economy in the United States. Number two, we want to try to mitigate any unnecessary risk. Of course, we will be taking some risk because this is investing, but we want to mitigate any unnecessary risk, meaning that any risk that we're taking that don't give us a higher chance at a better return. And the third thing that we want to focus on in this portfolio is having something that's passive that we can set and forget about. We don't want to create this portfolio and be checking it every single day, wondering whether price is going up, whether it's going down. We want to have the comfort and the security in our mind knowing that once we create this portfolio, that we can just forget about it until it's time to rebalance it, which is usually going to be 2 times a year. So how do we do that? Well, the first thing that we need to know with this 3-fund portfolio is what the 3 funds are going to be, and even lower than that, what are the 3 sectors going to be. So this part is actually really simple. The 3 sectors that we're going to be creating in this portfolio is number 1, a total domestic stock market sector, number 2, a total international stock market sector, and number 3, a total bond sector to get some bond exposure. Now I want to pause a quick second on the bond exposure part, because as I was starting my investing journey and as I was starting to learn more about investing, I was always taught or always told that investing in bonds was not the right way to go if you had a long time horizon to be investing your money. Because to me, it always seemed that when stocks go up, bonds go down, and vice versa, as when bonds go up, stocks go down. And over the course of the last 30 to 50 years or so, stocks tended to outperform bonds by a heavy margin. However, a book I read recently started to change my mind slightly about having bond exposure in my portfolio. And basically what was stated was that having some bond exposure in your portfolio, whether it's 10 to 20%, would allow you to lower your risk significantly by almost 10 basis points while not sacrificing that much in return. An example I saw in the book was that having 20% bond exposure in your portfolio would have lowered your worst single year stock market by almost 10% while only giving up 0.5% in gains in that same time period. So you're actually lowering your risk by a great margin by not giving up much returns at the same time. So now that we know what the 3 sectors are, let's talk about how to actually build it for yourself depending on what risk level you are at. Because the great thing about this portfolio is that it works for everyone. If you are someone who has low risk, then you can just allocate more to the bond market. But if you're someone who has a longer time horizon and you're willing to take more risk, then you can allocate more of your investment portfolios to equities. So right now I'm going to go through the asset allocation process from low risk to medium low risk to medium high risk, and then for a high risk or mostly equity portfolio. And at the end of the video, I'm going to be giving you some actual ticker symbols that I plan to be using to actually create this portfolio for myself in my Fidelity account. So starting with a low risk portfolio, this portfolio is going to be meant more for people who are near retirement or people who don't want to take a lot of risk with their money but still want to beat inflation on a year-to-year basis. And with all of these portfolios in equities, we're going to be allocating 70% of our money in domestic equities and then 30% in international equities. And that's if we don't look at the bond allocation. So with the low risk portfolio, obviously we want to have a much more heavy bond position, meaning that this portfolio is going to have 80% in bonds. And with that bond position, we're going to be allocating 14% to domestic equities and 6% to international equities. You could make the argument to say that this portfolio is much more income focused and really meant for the person who's planning to use their money much more sooner. However, moving on to the medium low risk portfolio, this is how the allocations stand up. In this portfolio, we're going to be allocating 28% to domestic equities, so double what we had in the last portfolio, and also 12% to international equities, so double in the last portfolio portfolio once again. And then in bonds, we're going to be dropping that allocation down by 20%. So the bond allocation will only be 60% in this portfolio. So to me, this is still a very conservative portfolio because over half the portfolio is allocated to bonds. And this should also be for someone who does not want to take a ton of risk with their money in the stock market. But this leads me to the medium high risk portfolio. And in the medium high risk portfolio, we're going to be increasing our domestic equity allocation by 14%, all the way up to 42%. Our international equity position is going to be going up by 6% or 18% of this portfolio. And then our bond allocation is going to fall by another 20% to 40% in this portfolio. Now at this point, we're still in that conservative to moderately aggressive range just because of the heavy bond position. But as I said, having some bonds in your portfolio does still provide similar returns by decreasing your risk dramatically. And that leads me to the high risk portfolio, or the most aggressive portfolio out of this lazy 3-fund portfolio allocation. And with this aggressive high risk portfolio, we're going to be allocating 56% of our portfolio to domestic equities, 24% of the portfolio to international equities, and then dropping our bond allocation to 20%. And for example, if you are someone like me who is 22 years old and also doesn't plan to touch that money for at least 20 years, I would personally go with the high risk portfolio. However, you should definitely do a deep dive into your financial situation so you know exactly which portfolio works for you best. And since I plan on actually building this portfolio with a Fidelity account, let me give you some actual ticker symbols that I plan to use when building this portfolio. So since I'll be opting for the aggressive allocation, which was the high risk one, what I'll be using is the 56-24-20 allocation. And with that, my domestic equities position will be in the index fund FSKAX, which is the Fidelity Total Stock Market Index Fund. The next thing I'm going to be investing in a 24% international asset allocation will be FSPSX, which is the Fidelity International Index Fund. And lastly, at a 20% allocation in bonds, I'll be investing in FTBFX, which is the Fidelity Total Bond Fund. The reason why I'm choosing these three particular index funds is that they have a really low expense ratio, which means I won't be paying a lot of money out, but I still will be generating a good return as the stock market grows. And obviously, the plan behind a lazy portfolio like this is to do as least trading as you possibly can. So you're not going to be encouraged to check the balances every day. You're going to put your money into it and let it grow. And when you do need to place trades or rebalance it, you should only do that twice a year. So if you set this portfolio up on January 1st, you should go back sometime in June and sometime in December to do a full rebalance on it. And also, if you plan to contribute to this portfolio on a monthly basis, you should contribute your money to the allocations that are underweight, meaning that if your stock investment has gone up a ton and now it's weighted at 90% of your portfolio now, when you add new money to the portfolio, you should allocate that new money to the bond sector just to try to keep the allocations intact. However, with all that being said, I really do hope you found value in this lazy portfolio overview. I will be creating an entire video of me setting up this lazy portfolio sometime in the near future. I just have to wait for all of my assets to transfer out of Robinhood and out of Charles Schwab as well, so keep an eye out for that video. But if you did like this video, don't forget to drop a like on the video for your boy. And if you want to get 2 free stocks, don't forget to use the link in the description where if you sign up to WeBull and deposit $100, they will give you 2 free stocks just for signing up and creating an account. And with all that being said, I hope you have a wonderful rest of your day, and I'll see you in the next one, guys.